Tariffs are often seen as a benefit to companies like Tesla in the electric vehicle market who have manufacturing capacity in the US and in Europe, two of the largest markets for electric vehicles. And those are really the two biggest markets that are trying to protect themselves from vehicles manufactured in China that are a little bit cheaper, arguably even higher quality than a lot of the vehicles that are being made in the US and Europe. But recent tariffs that were announced in Europe include tariffs that are going to hit Tesla. And this is something that we have seen over and over again from the company. As much as we like to think of Tesla as a US manufacturer, a lot of its manufacturing happens in China. A lot of those vehicles from China get exported to Europe. Some components get exported to the US. Other components are imported from manufacturers in China or Southeast Asia, like battery components, and end up in cars in both locations. So what we're actually going to see is higher prices for Tesla vehicles because of those import costs. So I want to get to exactly what we know today, why this may not be all that bullish for Tesla and may actually put the company's massive investment in China in even more peril, because the other Chinese manufacturers are arguably making a more compelling vehicle for the Chinese market. And if Tesla is limited to that market for the vehicles manufactured in the Shanghai plant, that could be a difficult position for them financially. But let's go through all the details today. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. You go to fool.com/ASYM. They'll give you the top 10 stocks to buy right now. Let's get to the news directly from the EU. This is from the European Commission, and this was released this week. So that an investigation provisionally concluded that electric vehicle value chains in China benefit from unfair subsidies. Tesla was not the target for a lot of these investigations, but you can see that BYD was hit with a 17.4% import tariff or duty, additional duties, Geely 20%, and SAIC 38.1%. Other battery electric vehicles producers in China, which cooperated with the investigation but have not been sampled, would be subject to a 21% increase in duties. Tesla was specifically called out, saying that one EV producer in China, Tesla, may receive an individually calculated duty rate at the definitive stage. So we don't know exactly what that means. They do have a manufacturing plant in Europe and Germany. So this is the argument that Tesla is going to be making, is that, hey, you want us to build plants in here and have jobs here. We have that, but we've been importing at least components, sometimes finished vehicles, to the European market to be cost competitive. In response, there was a number of headlines this week saying that Tesla will be increasing prices in the European market because of these tariffs. We're anticipating a requirement for us to increase pricing for the Model 3 vehicles as of July 1st, 2024. So coming up here in a couple of weeks. This is due to additional import duties likely to be imposed on electric vehicles manufactured in China and sold in the EU. So the implication there is they're producing these vehicles in China, selling them in Europe. So they're going to be more costly. To make the same margin, they're going to have to raise their prices. Now, tariffs are not new in renewable energy. We've seen back and forth of tariffs, particularly in the solar industry, which I've followed for well over a decade, and they just kind of go all over the place. And what happens is that manufacturers end up moving where they're manufacturing their vehicles or where they're getting parts from based on what tariffs are and where those tariffs are coming from. So a lot of manufacturers, some companies who want to import vehicles into the US, are looking at assembling vehicles in Mexico. That's something that US companies do. And if you're a Chinese manufacturer, why don't you get most of your components and your engineering from China and then just do your finishing production in Mexico if that's more cost effective and helps you avoid those tariffs. Those would be the kinds of things that they're going to do. Tesla has often been more concentrated than a lot of its competitors. It builds these massive factories. So you have the massive factories, two of them in the US, one in Germany and one in China. And that's going to provide a vast majority of the products that Tesla is making. So there is the ability to move some of that manufacturing to Europe, but that's obviously going to be much higher cost than it is to produce vehicles in China and then export them to the European market. So this is really the balance that Tesla is going to have to play. And I think what we're seeing here is that the Chinese market, Chinese auto manufacturers, continue to have a massive impact on the profitability and the prices that companies can charge for electric vehicles around the world. And this is really hitting Tesla's growth, so top line results, and hitting their margins. That is what has really suffered over the last 18 months. So let's look at the details behind that. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. You can see here that Tesla's revenue growth has really stalled out, basically flat for the past year, actually in decline sequentially as of the last quarter. And there's a couple of reasons behind that. Deliveries have not grown at nearly the same rate and actually started to come down a little bit. But pricing is really the biggest challenge for Tesla. And they've had to lower prices to be competitive with other manufacturers in the market. They've lowered prices in China, they've lowered prices in the US and in Europe. And the result of those lower prices, as a lot of other EV manufacturers have brought product online, has been margins have been dropping like crazy. This is a look at Tesla's gross margins in red and operating margin in blue. You can see that during the peak of the pandemic, when there was a shortage of vehicles, late in 2021, early in 2022, Tesla was able to raise prices, and they were significantly raising prices on all of their vehicles. They were actually producing basically as many vehicles as they possibly could, as a lot of other competitors dealt with a chip shortage. As that subsided and supply came back onto the market, both in electric vehicles and in traditional internal combustion engine vehicles, you can see that that pricing power really went away. Gross margins went from 27.1% to 17.8% over the last 12 months. The operating margin is now just 7.8%. That's in line with traditional automakers. So Tesla is now not a high margin automaker, not generating anywhere near the 25% gross margin that Elon Musk has talked about for years. And the reason is that the competitive environment just is not conducive to that. Companies do not make millions of vehicles and charge high prices for manufactured goods like this. There's no network effect in the auto business. There's not a lot of pricing power. A lot of the things that you can do as an automaker are ultimately copied by everybody else. And that's exactly what we're seeing with electric vehicles today. Tesla's best copiers are oftentimes the companies in China. And it's arguable, I think, today that they're actually innovating faster and doing more impressive things with software, with self-driving, than companies in the US and Tesla itself. So that's put a lot of pressure on the company. And now we have tariffs in the EU and the US that are going to impact Tesla's cost structure. It's also going to impact everybody else's cost structure, at least most companies' cost structure. But this is going to make it harder and harder for Tesla to make money. And we have already seen that Tesla's free cash flow went negative last quarter. Even if you pull back and look at the annual numbers, cash flow peaked for Tesla in 2022. That has dropped like a rock as that pricing power that I talked about earlier just evaporated. And this is something that is really in the auto market is Tesla and electric vehicle specific. We have not seen the same pricing pressure on internal combustion engine vehicles, specifically on vehicles that traditional automakers make, like trucks and SUVs. Those continue to sell extremely well. They continue to generate very high margins at the manufacturer level. Yes, things have changed at the dealer level, but Tesla, remember, owns all of its dealerships. So it was able to take all of that margin that dealers were getting during the pandemic. Now, dealer margins are going down and we're seeing Tesla's margins go down, but you're not seeing the same impact on a lot of the auto manufacturers like GM, like Ford, who remain profitable because they don't own their dealerships. So a lot of dynamics that at play there, but one of the things that I think we're going to have to think about is the impact that tariffs are going to have on Tesla, because Tesla has really been leaning in to growth in that Shanghai facility. That's where about half of their production is right now. They're building another battery manufacturing plant there. So that's obviously where they're seeing a lot of their production growth. Tesla has put off their expansion into Mexico, and now walls are kind of going up around the US and around Europe as they try to protect the manufacturing that they have for the auto market from specifically Chinese competitors. So something that may not actually be as bullish for Tesla as you might think. But what do you think about the new tariffs coming to Europe and the impact on Tesla? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.